Good morning, good afternoon, and good evening to those tuning in remotely. I'm Elisa Martinuzzi, editor for EMEA Finance and Markets for Reuters, and I'm honored to be hosting today a conversation with Nicolai Tangen, the CEO of the world's largest sovereign wealth fund, Norges Bank Investment Management. Tangen oversees the equivalent of just under 1.7 trillion, if I'm not mistaken, in Norway's oil riches that are now invested across shares, bonds, real estate, and infrastructure. That's about $300,000 for every Norwegian, if I'm not mistaken. Quite a lot to go through today. The fund's investments account for almost, I think it's about 1.5% of the shares in all the world's listed companies. So your thoughts and views of impact on small, big business and governments around the world, shaping views on global portfolios, and there's quite a lot here in Davos to be going through. I thought I'd start with one of the themes of this year's World Economic Forum here in Davos, artificial intelligence. UBS analysts in a recent note said that big tech firms will likely make more headway in monetizing their AI spending this year. AI monetization is primed to improve sharply this year. And they're seeing AI adoption picking up right across industries and broadening in 2025. I wonder if you share that view, and how does the actual adoption of AI across business affect how you look at investing in companies? Nicolai, welcome.
Yeah. Thank you. Well, we are invested across the world. We are invested in the big AI companies in America. They are a large part of the portfolio, and we have, of course, made a lot of money there. Now, I think what is interesting is to look at the adoption of AI. It differs very, very much from sector to sector. Within research, within pharma, within defense, there are a lot of sectors where they have been, very much integrated. Of course, self-driving cars and so on. But there are a lot of people who are slow in adopting it, and I think it's just a reflection of us as human beings. We are just really slow in changing our habits. And so what we are doing in our firm is that we are putting it in from the new starters. Pretty much everybody who joins us, they know how to code. We are really very loud about it from the top, and we are kind of really trying to get everybody to use it in the middle. So we asked everybody in the firm just before Christmas, how much have you improved your productivity this year by adopting the new tools? And on average, they answered 15%, which is a very big number. And we will continue that drive in 2025.
But if you look at across businesses, where do you think, which industries might have surprised you and sort of how quickly they might be looking at adopting AI? I mean, I've spoken to a few finance executives here, and I'm not getting a sense that 2025 will really be a turning point in terms of adoption.
No, I don't really think so. I think so far it's very much about automating tasks which are pretty boring. Now, we are using it in things like helping us. It helps us to minimize trades. It helps us to deploy capital around month end. But they are not really making autonomous decisions for us, for instance, yet. Good. And I suspect that will take time, and that we will always have a human being controlling these things.
Right. You've spoken a little bit in the past about the links between climate and finance and tech and finance and all of these strengthening to some degree. Winner takes all in many industries. Largest companies now being linked very much to the same risks, be it concentration geographically or supply chains. I wonder, as an investor, how you go about hedging and managing investments around these risks.
Yeah, I don't think you can hedge it. If you're a large investor, I don't think you can hedge it because it's so integrated into everything you do. But you raised several different topics there. And I think what is interesting is that over the last few years, some of these risks are integrated in a different way than they were in the past. For instance, climate and finance. We are seeing from LA just how the climate is impacting finance. We are seeing how it impacts raw material prices through worse harvests and so on. And this is a pretty new phenomenon. Then we are seeing how tech and finance is being closer integrated, how tech and geopolitics are more integrated. So this is all coming together. And I would say just over the last 5 years, the whole investment universe and the way we look at the world has very much changed.
Do you think what's the biggest takeaway from that? Is that the predictability of returns or the predictability of where things are going? Is that what's changed most?
I think predictability is low. I think there is an argument for being even more broadly diversified than in the past and even more long-term in your thinking.
and we'll get to some of that. I think, if I'm not mistaken, you've held a view for quite a little while that, that returns would be low, and it hasn't exactly borne out that way. Risk assets have done very well. Where do you see the biggest risk to markets as we go into this year?
Yeah. Now, you have kind of the things you know about, and then you have the things you don't know about. Now, if you look at the things you know about, there I would say inflationary pressure from what's going on in the US now, and whether you get to a point where investors think that government debt is generally too high across the world, and they want a much higher coupon to finance governments. That's for sure a risk. But what really derails markets is the stuff you never thought about, the things you have never seen before that you cannot model. Whether it's a meltdown of nuclear reactors in Japan, or COVID, or the financial crisis, just the things you never had expected or thought about. And these things, they come up every so often, and for sure they will come up again.
A few things to unpack there. You mentioned sovereign debt. Where do you see that risk of being most acute in terms of the pressures on governments raising funds and investors taking a little bit of a pause?
Well, it's a phenomenon we're seeing across the world, right? I think IMF calculated that there was total government debt of $100 trillion. I mean, these are huge numbers, and they just continue to increase. Now, it can go on for potentially a long time, but it may not.
But if you look at sort of geographically, is there anywhere in particular that you're worried about? We've seen obviously some stress points in the UK, for example. We've seen it in France.
Well, you've seen it in many countries. Yeah.
And then, in terms of factors that you need to think about, going into this year and further, one of the biggest risks that I think the World Economic Forum in its survey came up with, that people shared, risk to the economy is war. I wondered to what degree you factor in lasting peace in Ukraine and the Middle East going into this year.
Yeah, for sure, these wars are huge tragedies. They are humanitarian, disasters in many ways, and we must not forget that. If you just look at the pure impact on financial markets, it has been pretty limited, and so I think it's difficult to pencil in any outcome into your projections, and I'm not sure it really matters for financial markets, strangely enough.
Unlike trade wars?
Trade wars will be more detrimental for financial markets. Tariffs, very negative, and I think if we get big tariffs coming out of the US, it's negative for European companies. We've started to see that already. European companies have underperformed US companies. It's partly explained by that.
Oh, really? Already? So,
yeah.
And how do you see those?
Well, it's been going on for more than 6 months. The fact that Europe has underperformed the US. Now it's been going on, of course, for much longer time than that. You go back, you look at the last 10 years. US companies have compounded at 3 times the rate of Europe. So it's been a big gap there.
Yes, we'll get to that in a little while along. In terms of private versus public markets, I wonder how you would compare the risks and returns there at this juncture, and yeah.
Yeah. So there is a discussion going on in Norway about that for the moment, so I should be a bit careful about talking too much about it. But what we have seen over the last few years is that the number of companies being listed on the stock exchange has been going down, and also that the concentration risk in the listed market is very high, because some companies have grown to be very, very big. So probably the risk in the listed market is higher than in the private market just now.
Right, but those discussions at home are ongoing as to whether the fund could invest in private assets. So
there is a solid political process which is ongoing there.
Now, wanted to sort of delve into some of the topics that geographically that we want to look at. I think it was 2023 when you closed your offices in China, and I think that the decision was an operational one, from what I understood. But I wonder to what degree that also reflects your view on opportunities to invest in China. Obviously, not being there doesn't give you as much visibility on what's going on the ground. I mean, there are some who say that the global growth engine for the last 20 years may actually end up being suffering from a Japanification, if you so will. I wonder what your thoughts are on that.
Yeah. I don't have a very strong view on China. We closed down the office we had there. That was just for operational reasons. We moved people and systems to Singapore, where we already had a big operation, so I don't think you should read anything into that. Now, the way I look at investments generally is that I don't feel we invest in China. We invest in Chinese companies, right? We own less than a third of the companies listed in China, and we are seeing good investments in China as we do elsewhere.
And what's your sense as to the economic recovery there, and what are you picking up?
Well, what we hear is that it's slow, right? Mm-hmm. Yeah.
And do you think China will need to put in more stimulus?
I haven't got a strong view.
Okay. Now let's move closer to home. Yeah. I think a third of your funds, if I'm not mistaken, are in assets in Europe versus about half in the US. And this is a region that, for some time now has been marked by stagnation economically, political instability to some degree in the core economies for sure, and lack of productivity growth. Be curious to hear your message for von der Leyen and the incoming German Chancellor. What are the top priorities for the EU, and how do you get there?
Yeah. First, these are good politicians. I never tell anybody anything. They know very well what to do. But of course, we have the Draghi report as a backdrop here. So, and it's easy to agree with that. The first thing I want to say is that we got some amazing companies in Europe, right? We got leaders in luxury goods. We got great industrial gases. We got some great pharma companies. Industrials in Sweden and so on. We got a lot of good companies, but the life is not being made easy by all the regulations. And, I look at regulations a bit like, so you come into a bar, okay? Now, every bottle tastes really good on its own. It's just that when you pour all of them into a bucket, it doesn't taste so good anymore. And it's the same with regulation, right? Each one of them, right. they make eminently sense, and they're all very clever and good and well meant, but it's just like the total burden is it's huge.
So what would the roadmap be in your view for the EU? Like hold all new regulation and sort of take a pause?
Actually, earlier today I met with the commissioner who is in charge of simplification and so on. So they are on it, but it's not easy. I mean, it's very complicated to simplify. So let's see how it goes. I'm sorry, and this is of course being made even more important because they're rolling back regulations in the US, fast, and so makes it more important to do it in Europe as well. And we got new regulations coming in, like for instance climate reporting, really, really important. But you have alternatives between something which is very complicated, it's called CSRD, where you have to report on 800 different things, or you have ISSB, which is much simpler, and which has been adopted by other countries. So, you have the choice just how complicated you want to make it.
And then in terms of industrial policy, is there a particular area you think, really ought to take the top slot? I mean, is it energy? AI will be soaking up more energy. Is it defense? What is it that Europe should be prioritizing, would you say?
Well, I think it's interesting because historically the EU was focusing in a lot on competition and to making sure there was huge competition in all areas, in all countries, right? So you wanted to have 3 telecom operators in each country. So you end up with nearly 30 in the whole of Europe, whilst you have 3 in the US. So you end up same in the banking sector. We want to have a lot of banking competition in each country, but it means that you've hardly got any very large European banks, and that focus seems to change a bit now. So there is more focus on making kind of stronger individual companies which can compete with the American companies.
Speaking of competing with America, I wonder if we could talk a little bit about Britain. I believe you made a fresh investment in real estate. There this week.
We have great real estate investments in London, for instance.
But
we love it.
We've obviously seen some tensions in the markets of late, particularly in the bond markets, and some have remarked how Brexit Britain is vulnerable to these shocks because it's a less core asset post Brexit. And if I look at your numbers, I think Britain represented about 9% of the funds in 2016. It's now about 6%, which reflects the weighting. But do you share the view that Britain risks being less core, and what are the implications of that for Britain in the long term, particularly as we've got a new U.S. administration and potentially new trade war?
Yeah, first of all, I love Britain. I lived there for 30 years. Fantastic place. But what has been happening, of course, is that many companies which previously were listed on the London Stock Exchange have moved to America for several reasons. It's easier to pay executives and the board higher salaries. Some people argue that there were higher valuations there and so on. So there has been a move, right? So there are fewer listed companies and the market capitalization of the stock exchange has shrunk. And that's reflected in our holdings as well. Mm-hmm. Now, we don't invest in England as such or Britain as such. We invest in the companies there. You got great international companies and you got great consumer good companies, and we think you have good companies there.
What should the Chancellor be doing though to get the growth economy, get the economy growing again rather?
Oh, she knows that much better than me.
One place that doesn't have an economic growth issue is the US, of course. About half of your investments are there. Yeah. What do you think about to spread the risk? And is there a thinking about perhaps rebalancing the portfolio a bit, given the concentration there?
Well, you do have a big concentration risk in the US. The thing is that you have a big concentration risk in the world generally in pretty much everything, and it's because this winner takes it all situation, right? So in pop music, there are no more people listening to Taylor Swift than all the jazz music and classical music combined. In football, our fellow Norwegian top scorer Haaland, he is making tons of money, much more than other people, just because he's so good. So this winner takes it all is kind of coming into all parts of the world. It's in tech companies more than other places because you have these platform structures. So, you're on Facebook because there are so many people on Facebook. You take an Uber taxi because there are so many of them, right? So you get this, the fact that they are big makes them even bigger. And then in AI, it's even more extreme because it's so expensive to develop these models. So, this is a development which has been going on for some time, well, for a long time actually, and I just think it's difficult to know where that's going to end.
But are we at a point of an acceleration, do you think?
On that yes. Feature? No, it's been going on for a long time. Yeah.
Did want to ask you what your views on the US, and you've obviously had a change in administration, and you've got the outgoing administration talking about an oligarchy potentially sweeping into America. There has been concerns about potential influence of business on politics. How does that affect your view on the US as an investment proposition?
Yeah. So just make it clear first, there are many things we do not agree with, okay? I mean, we do not agree that one should roll back climate efforts, that one should stop looking at diversity issues and so on. So there are a lot of these things which we think will be negative in the long term. But what we're seeing, and also some of the proposals there will be negative for our European holdings. So that's the negative side of it. When you look at the pure American companies and how they are performing financially, CEOs are very optimistic. I mean, it's unbelievable in Davos now. The world is just totally split. You meet the Americans, it's just like is a real party. You meet the Europeans, funeral. It's just like very, very distinct. And I met with more than 50 American CEOs in Q4, and 9 out of 10 say that their business is no better and that they're really optimistic, partly because some of the regulations have been rolled back.
Right. But going back to you said, you wouldn't view favorably, projects to plans to roll back DI frameworks, for example. Will you be discussing this with the US tech companies when you meet with them? Will you
Absolutely.
Be discussing their relationship with the US government when you meet with them? And what will you be saying?
No, we have more than 3,000 company meetings a year with executives. These, at all levels, CEO, CFOs, board members, chair. These are some of the things we discuss. We have clear expectations for how we think that companies should conduct their business.
How concerning is that Meta is abandoning fact-checking? Is that something that you might discuss with them?
Well, that's one of the things we would typically discuss with them because it's in our expectation documents that it's important to do these things. It's also important in terms of children's rights, and so that's also where we cover social media and the implications of this.
And you've been quite vocal about your views on the split between chairman and CEO.
Yep.
What are how optimistic are they that those views are going to be listened to in this current environment?
Well, I think it's very interesting. So we think that the chair and the CEO should be two different people, and we just think that's good corporate governance is well established. For instance, in Europe, it's also actually an increasing trend in the US. So 10 years ago, there was something like 40% of companies had the combined role in one person. Now that's gone down to something like 30. These are rough numbers, but so it is moving, we think, in the right direction.
Wondered if we could talk a little bit, just briefly, on sort of the diversity issue and Switzerland in particular. The Swiss parliamentary inquiry into the failure of Credit Suisse recently recommended that there'd be a cap potentially on how many foreigners could be on the board of UBS. How would you view that?
Well, first of all, they have to do what they want to do in Switzerland, so I'm not designing here. But, we own nearly 5% of UBS. As an investor, we want to have the best possible people on the board.
So does that mean you wouldn't view that necessarily favorably?
Well, I don't think I need to even answer that question. I mean, it's just like, I think you want to have the best people on board.
Great stuff. Wondered if I could just quickly hear your thoughts on climate finance in particular, and some of the banking, the alliances that were built around some of the financial institutions to push through net zero targets are being disbanded, or certainly the Wall Street banks have been leaving them. How do you see the engagement between from banks and sustainability over time, and does that worry you that these alliances are weakening?
Yeah, it's a worry that these alliances are weakening. At the same time, I would say that we measure companies on what they're actually doing, not whether they're a member of an alliance or not. So what matters is what they do, whether we can measure what they do, and whether they move in the right direction.
And what's your early readout on that, on their commitment?
I think the commitment for many companies remains very, very strong, and I think many companies will continue to do what they've always done because it makes financial sense.
Speaking of making sense, you've suggested that companies move away from quarterly reporting to half-yearly. And I wondered what kind of reception to that proposal you've been receiving here in Davos this week. What do investors say? What do companies say? I'm sure companies love it, but
companies absolutely love it. I even got a hug earlier today from somebody.
Sorry?
I even got a hug earlier today from somebody. No, I think it makes a lot of sense. Doing quarterly reporting, i.e., going through that whole machinery every single quarter, takes a lot of time. Okay, a lot of effort. It's very costly. But more importantly, I think it leads to very short-term focus, dispositions which have as the goal of reaching numbers. It leads to you postponing important decisions and costs related to restructuring. And I just think it makes you a bit less agile as a company. Now, we went from quarterly to half-yearly, and it made our life so much easier. So I think it makes a lot of sense. We are also seeing the development of more companies choosing to be private for longer, and one of the reasons they give us is the burden of all this reporting. So I just think if you believe in a well-functioning market, I think it's better to do half-yearly reporting.
But isn't there a risk of less transparency, particularly in certain sectors which are more complex? Have you not heard many concerns about that?
No, we don't think that's the case. You need to have very, very deep and detailed reporting every 6 months, and then if there is a big change of developments, then you report it. But that you have to do anyway.
And have investors that you met with here also received this positively, or is it mainly companies?
It's generally perceived positive, and generally you have the opportunity to do this in Europe. And some other places. So we think this is a natural thing. And
have you had any engagement with regulators on this yet?
We have also spoken to regulators.
And?
So that depends from where they are and what they think.
Any sort of indication of their thoughts?
Well, as I said, in Europe, it's already allowed many places. In the US, that's not introduced yet.
And I know that in terms of regulation that might introduce new things. I'm thinking about new assets. I'm thinking about crypto. I realize this is not part of your portfolio yet.
Yeah.
I wondered if you could...
I think you can even drop yet, because I don't think it will be anytime soon.
But what are your views on central banks, for example, establishing Bitcoin reserves? Is that a good thing?
I haven't got it. We are situated within the Norwegian Central Bank, and our chair is the central bank governor. So all these type of questions we would refer to the central bank.
But you know, in terms of the digital asset space, are you seeing more adoption of tokenized tokenization in financial markets? Is that something that you're seeing as potentially having sweeping effect soon?
I haven't gone as strongly on that.
Okay. I believe you're keen to take on a second term as CEO of Norges Bank Investment Management. Wondered what your ambition would be with the second term. What would you be hoping to achieve?
Yeah. So the job I have it's a 5-year term, and then I have to reapply. And so I'm very keen to go for another term. I have updated my CV. I have sent in the application. And what is important, that fund is so important for the country that it needs to be the best person. If there's somebody else who can do it better than me, I mean, for sure, he or she should get that job, okay? Very, very important. What do we want to achieve? To be honest, we've made a lot of changes since I took over. It's to really bed this down. It's to increase what we do on the performance side, continue to develop the people, continue to develop communication, continue to strengthen the whole technology aspect of what we do, continue to strengthen cyber defense. All these kind of things is more of the same. And, we have a goal. It's in our strategy document. We want to be the leading large firm in the world, and that's what we're trying to achieve. And so we will continue that.
And what would you say you've learned as a leader in the first term that you would do differently in the second term?
Oh my, I mean, I learn every day. I make so many mistakes. And so it's just to learn from your mistakes. It's to, I think what is really incredible is when you manage to really empower people to do the job, not to micromanage them, give them a lot of slack, and just see what an incredible job people can do when they get freedom and trust. That is just a wonderful thing.
Excellent. And does anyone in particular that you've looked to as a model leader in your life?
Well, the fun thing, so I'm not going to market our podcast, but actually I am going to market our podcast, because we have a wonderful podcast called In Good Company, where we talk to the best leaders in the world. We have now interviewed 100 of them, and I steal good ideas from all of them. Most of the interviews we come out of, I think, wow, that's a great idea. We need to steal that one. And that is just like fantastic.
And then you put them into practice.
I'm sorry?
You've put them into practice, have you?
Totally.
So I wanted to go back to sort of, the bigger themes from the World Economic Forum this week, the outlook for the economy, and just leave with some thoughts from you on that. What's your sense as to the concern? What's your sense as to the magnitude that tariffs of impact that they could have on inflation, for example, and the outlook for interest rates? Are we in a higher for longer environment?
I think we probably are in a higher for longer. What we are seeing is that the initial comments about tariffs were, we were talking about huge tariffs. What we're seeing now is slightly smaller tariffs. So let's hope that we can just muddle through this whole thing. I mean, that's what generally happens with the world. We muddle through difficulties. And typically we end up in a pretty good place. That's what's happened historically. And optimists make more money than pessimists, and they have a better life.
But do you think that, and do you worry about potential repercussions in the way of, for example, currency wars, and the volatility that might spark? Well,
that's so that would be a worst case scenario. But let's just hope we don't get into that.
The hope is not a strategy, though, is it?
No, hope is not a strategy.
And then one final remark, if I may, just back to the theme of, potentially the increase of conflicts of interest between policy and companies in the US. To what degree should one look at that, perhaps through the prism of, an economy that might not be as competitive or efficient as we've been used to? The US has obviously been an economic model that the world has looked up to for quite some time. Is that something you think about?
Well, we think about it, but we try to we invest in the companies, and we try to keep this very company specific. And so, of course, it's something we talk with management about. But in terms of investigating it as a bigger picture, I think we leave that to you journalists.
Well, we report the facts. We don't take views on that. Thank you very much, Nicolai. Thanks for your time.
Thank you.
And thank you.